Welcome back, Money Mondays.
We are back after a very long trip.
Where'd we go?
We went to Atlanta. What did we do?
MFIN Conference.
We had our conference, and we did our company corporate annual planning as well. So we're back. We're not quite rejuvenated, but we know what the company is doing for the next year.
Where's my coffee at?
Things have been so hectic, we didn't even get to get our typical Starbucks. So instead, we went for fake bucks, and that's about what we're getting to use today. So,
but we are excited to be back here, folks, for Money Mondays. We do this every Monday at 3:30 Central.
We rushed back from the conference just to make it back in time. So had a good time in Atlanta, though. So the conference, we had, 400 people out there.
About 400 people.
Sold out.
A lot of great feedback.
Really
good panelists, good speakers, a lot of great networking. I mean, our event is a one-day event for people that have been there, people that haven't, right? We typically put on a one-day event. It's MFIN. Next one's going to be in Houston. What's the date?
February 11th, 12th. That's Saturday.
That's 11th. It's 11th. February 11th.
One of those two.
So we'll talk about that later in the show.
When's the next one after that going to be, Ben?
It's going to be in July.
July what? 22nd. There you go. I got it.
So it was close.
We got them all figured out for next year, folks. So look forward to hopefully seeing you guys there, and we'll share a little bit more about the Houston conference coming up here at the end of this Monday Mondays.
So what are we talking about today, man?
Talking about the most common underwriting mistakes in the multifamily world, not the ecosystem, the whole world.
The whole entire world.
We've done a lot that we're underwriting in our days, and happy to share some of that. So first, before we get going, what is underwriting, Ben?
So a lot, and this is, I'm glad that we're actually starting here because a lot of people do kind of have a little bit of misconceptions about what underwriting is. You're essentially taking the financials, the past financials that you can get from the property. You're getting a rent roll. What's a rent roll? A rent roll is just a roster of all the tenants and when they moved in and what their rent is and when they're going to be moving out, right? You want to obviously have good, accurate data there. You're taking that all together and you're putting it into your spreadsheet to determine, okay, what's it currently looking like, right? Is it making any money? Is it not making any money? Where can I put money into the property to improve the operations, right? Get rents up. And then you're doing a pro forma projection out. Typically, we've seen it anywhere from a year to 10 years out. And there's a lot of spreadsheets out there. Obviously, message us. We use various ones for various reasons. Michael Blanc has a great one. It's $97. Go check that one out. I'll just go ahead and give him a little.
I wonder if it's gone up due to inflation.
It might be. I don't know. Inflation's a killer here. But anyway, whenever we bought it a long time ago, it was $97. But anyway, so check that out. And what you're trying to determine is, based on what your investors are going to expect in terms of returns, does that deal hit that box?
Yeah, so underwriting, right? Whether it's real estate or something else, it's really a fancy way to say smart analysis.
Yes.
Right? Whether it's a lender underwriting you, whether it's you underwriting a deal, whether it's an insurance company underwriting you, right? It's underwriting really just means sophisticated analysis. That's how I like to maybe explain it.
Yeah, I haven't heard it that way, but that's, I think that's, you're analyzing, is this a good deal or not?
Actually, I'm going to look up the official definition. Really, Sign and accept liability under, thus guaranteeing payment in case of loss or damages.
I don't know if that has.
I don't like any of these answers, actually.
All right, we're gonna nix Webster. Didn't have a great definition, and that's why it's a little bit of a black box for some folks.
All right, here it is. I found it. Here's the one.
Right,
underwriting is the process through which an individual or institution takes on financial risk for a fee.
Yeah, I guess, and you're looking at it from this perspective, right? If your returns are lower and the amount of work that you have to put into it, the risk adjusted, there's a lot of risk there, right? And you have to determine, is this deal going to be worth your time, your effort, and the risk that you're taking on to be successful, right? And so, obviously, the higher the returns, the better the deal, supposedly, right? And so you have to dive into the numbers, folks. So even if you're getting into it, even if you want to be passive, right? You don't want to be like us. You don't want to be buying deals. You don't want to be managing deals. You have no desire to do that. I still suggest people get comfortable underwriting deals because it's so important to understand, are these assumptions aggressive, right? Are they even realistic at all in that market, right? Somebody could say, hey, payroll's $1,000 a month. And I'm just going to tell you, no, it's not. It's a lot more than that, or $1,000 a unit, excuse me. It's more like
in another country.
Yeah, if you're in another country, if you're in another country, then yes. But realistically, it's gone up quite a bit over the last 10 years, and now anywhere from $1,500 to $2,000 per unit.
So you're assessing risk,
Yes.
risk of an entire deal, assessing risk with your assumptions, right? Maybe you think you can get $1,250 payroll. There's a risk that you might not be able to, right? With inflation, all that. But again, if you're comfortable with that level of risk, great. But underwriting is really about understanding it and making your decisions based on
maybe
that.
your property management company comes back and says, you know what, you're way aggressive on this, this, and this, and this. You pop that into your spreadsheet, now the deal doesn't look as good, right? I've also seen it on the flip side, right? Where they're gonna say, hey, I think I can get more rents than what you're projecting. That's good. So what's happening is you're getting this financial data from a broker or a real estate agent, and you're putting that into your spreadsheet, and you're doing your financial projections into the future. And you're determining, do these returns make sense for me to move forward with the project, right? And then obviously you're getting validation throughout the process from your property management company and your insurance provider, and you're gonna find out what your lender is prepared to loan you on the deal as well. And so you're validating and you're massaging and figuring all that out throughout the process, and then boom, this is what it is, and then that's what you present to your investors.
And so just to recap, right, we're not going to teach you how to underwrite. That's
No,
not for this
no,
show.
no. We can't do it for a
right?
30-minute
But underwriting,
show.
you're basically looking at your debt, you're looking at your rents, you're looking at your expenses, combining it all together to understand what your risk profile looks like and what your return profile looks like. So that said, what would you say some red flags are, you know, with multifamily underwriting specifically, right? What would you
we'll stick to multifamily, right? You know, I think that there's a lot of smoke and mirrors in our business, and we're not here to name names or call anybody out, right? That's not the type of people that we are, but you just have to be careful, right? You know, some people are in it for fees, some people aren't in it for the long run. They don't care if they just put whatever number down on an underwriting and then present that to an investor. So some of the red flags that we've seen, we've looked at deals too as LPs, is mainly one of the ones that people really smoke is going to be the reversion cap. And so what is the reversion cap rate? Well, you have a going in cap rate. We've talked about this on the show.
And if you don't know what cap rate is, check out other episodes. Episode number, what?
I have no idea. We talked about it on so many shows. You know, but you can find a definition if you don't want to go look through all of our shows. There's definitions online, right? But there's also a cap rate when you go to sell. Right? And so what we typically will see people do, they'll buy it at, and we're just throwing out numbers, a 6 cap going in, right? But they're gonna say, well, you know what? I think I could sell it at a 4 cap, right? They have no basis for that it's gonna be a 4 cap in 5 years. In fact, that's probably way aggressive.
Yeah,
in
and
all
if it was
cases,
the flip side, you also don't have a basis either, right?
No,
if
you have
bought
no
it at
idea.
a 4 and you say
have,
6, you have no basis either.
And the reason that I'm gonna call this out as a red flag, right? You know, because that 6 could just as easily be an 8, right? What you try to do as a syndicator and a person that's putting deals together is you want to not necessarily underpromise and overdeliver, but you want to be conservative in your underwriting, right? So what we typically do is if we're buying it at a 6 cap, and maybe that's the stabilized, what it truly is, there's nothing necessarily distressed about it or off about it, cap rate in that market for that vintage in that asset class, what I'm going to take is anywhere from 10 to 20 basis points per year expansion of that cap rate. So what does that mean? If I'm buying it at a 6 cap and I'm expanding it by 10 basis points each year, right, and I'm going to hold on to it for 5 years, that means my reversion cap rate is going to be 6.5, right? Yeah. And the reason that you do that is just to be conservative, right? You're hoping that you sell it at a better cap rate.
If cap rates get better, great, but ultimately as an operator, right, you're trying to assess, how do I get myself into a deal with my investors that we think we can perform on? Yes. Right, and so again, maybe cap rates compress, things look great, but we like to pick on cap rate because it's one of the easiest number. It's a very subtle number that's really skews the deal heavily, right? Yep. And so again, that's why we like to look for deals that are more cash flow heavy, because cap rate is it's kind of a finger in the air side situation. So that's a big red flag that we do always look at very quickly. What else? So
I got 2 more, right? So typically you're escalating your rents and you're escalating your expenses, right? What we have seen people do is those escalators, this is typically what we call them in the business, and you're gonna say, what the heck is an escalator? And just say, okay, hey, after year 1, I'm gonna continue to increase my rents by 10% each year. If you're doing that, any crappy deal off the street is going to look incredible, folks, right? And as much as I'd love to say that that's going to continue, and in some markets it has been the case the last 2 years, that's not going to be the case moving forward. So you have to be conservative. And the rule of thumb is typically 3 to 5%, depending on the market, depending on the deal, of rent escalations each year.
Which really ties into one question that we just got. So, if you're watching this, we will take questions live. Please go ahead and ask them. We'll answer them here live. But one question from Omar says, what rent growth do you typically underwrite in hot multifamily markets? And that's a good question, right? As been said, historically, we're in the 2 to 3% rent escalators.
Yeah, or
maybe
you go 3 to 5.
Year one, as we're doing the big value adds, I mean, definitely it's more than that, right? And that's very deal specific.
Let's pause there because I didn't even get into that. So this is where people need to understand. You're going in and you're increasing rents significantly more than 3 to 5% in year one. Why are you doing that, right? Because typically you're looking for an opportunity where you can push rents organically already, right? Rents are already low. There's something that's not allowing them to hit market rents, right? Maybe the operations just aren't great. Property management company sucks. Whatever it might be, doesn't really matter, right? That's what your part of your analysis is up front. Now, that's organic rent growth. You're also trying to push rents by putting money into the deal, right? So if you're going to put $10,000 into a unit, my expectation is I'm going to be able to push some rents, right? Because you want a good return on your investment, right? So all of that's going to be, you're going to rack that in year one, right? Then moving forward, it's going to be 2, 3, upwards of 5% moving forward. But then
what would you say, to answer the question, right, in a hot market, right? I'd say it varies, right? Like in Austin, I'll say this, we're typically 3. On an Austin market, we're probably 4 for a few years, right? I mean, you're getting a market that's historically had 10% from year on year. So maybe you can get away with 4 in year 3, year 4, right?
I think it's...
But don't bet the deal on that, right? That's
the reason why we're including it in red flags. Because I think in a lot of cases, people, that's how they really juice the returns, is that they're pretty aggressive on what they expect to push rents to on a year-over-year basis, and it's just not going to be the case. I would say, to answer your question, Omar, man, I mean, it really depends on the market, really depends on, housing and supply and demand, right? A hot market, core area where there's just not a lot of opportunity to build stuff, Austin being a perfect example, or where they make it very difficult to build, again, Austin, your rent growth is significant, right? Now other markets going to be a little bit less, even in hotter markets, right? But there's not really going to be a rule of thumb. You're going to have to, and if you struggle with this, your property management company can also help you dial in what that rent growth could potentially be. And there's also Yardi and CoStar and Axiometrics reports that you can pull. Obviously, a lot of that costs money, but sometimes they will try to do a little thumb in the air as to where the rent growth is going to be in certain markets, right? So that's red flag number 2. Red flag number 3 is going to be keeping vacancy, both on the physical side as well as on the economic side, too low, right? And you're going to be like, what the heck is all this stuff, right? Well, you're going to have your gross potential rent, then you're deducting your physical vacancy as well as your economic vacancy. And I've seen on heavy value add deals where people have kept that at 2%. Yeah. Right, and it's just not possible when you're turning units.
If your property is 100% occupied, what can you bill out, right, in a perfect world, and then versus reality, what do you collect? And we've seen some deals where people will try to say that's 4% total.
Yeah,
that's probably not realistic, right? It's probably closer to 10%. Or if you're doing a C-class deal, it might be 13%, right? Yeah. Economic vacancy, right? And so that's why it's called economics, not the physical vacancy. Yeah. It's ultimately what is the missed opportunity of cash on that asset,
and
right? And it includes, evictions, delinquency,
all of that, right?
Down units, rented units to staff, concessions, all of that goes into that number.
So, to give you guys an example, right? You're going to bill out 100. If your property is 100%, you've hit your market rents 100%. There's no vacancies. You're collecting 100K. Right, that is maximum amount that you can collect.
That's a perfect world.
That's a perfect world, right? You shouldn't really, because you should never be at 100% occupancy in the first place. But you've got 2% physical vacancy. Now you're taking $2,000 off that 100K. Then you got another 2%, right? That you're going to call it economic, which is going to be your loss to lease. You're going to have your bad debt. You're going to have maybe a model unit. Maybe you have a down unit. Maybe you have employee units. Maybe you're providing concessions. All of that gets wrapped into economic, but I'm going to keep it really simple, and I'm going to keep these low numbers. Call that 2%. That's another $2,000. So of that property where you could, if in a perfect world you're collecting 100, now you're only collecting $96,000, right? So we're seeing people keep those numbers artificially low, but whenever you're putting a ton of money into it, you're turning a lot of units. There's a lot of just flux. Those numbers need to be actually a lot bigger. Right? And then the other thing too, what I'm also seeing people do that they smoke the numbers is maybe they're being a little more conservative on the year one, but then they immediately go to that 2 and 2 in year 2. right? And then it's 2 and 2 throughout the life of the deal. And I think that that's going to obviously artificially fluff up your income numbers. And so therefore, those are big red flags. So to recap, look at the reversion cap rates, look at the rent escalators, and are those aggressive? And then look at the numbers that they're using on the physical and the economic vacancy. I think that those are 3 big things that people need to pay attention to. If you don't know anything about anything, don't want to underwrite it, you just at least ask those numbers and you try to validate, do those assumptions seem aggressive? Do they seem conservative? Are they somewhere in the middle? That's what you got to determine, right? Because those numbers alone will skew a crappy deal to looking like a great deal and vice versa.
Absolutely. So let's see. So follow-up question from Omar. What are some of your go-to line items that you massage in order for the deal to pencil out to your desired return metric?
We don't like to massage anything. But, I think that there's, massaging comes as like a negative term, right? But I would say that there's certainly things that
massages, and that's
I do like to get massages.
Right?
It's been a while, but you can streamline certain things, right? And even at MFIN, we were talking about this. I was on the asset and property management panel, right? Say you're looking at the T12 financials, historical financials that you get from your broker, and the deal that you're looking at's payroll is $2,500 a month. And you know that market, and you know that your property management company can run that property at $1,500 a unit. Well, shit. I mean, you could do a deal right there, right? That's $1,000 per unit savings in payroll alone, right? So it's not that you shouldn't look for opportunities to streamline expenses. We talked about this on the panel. I just think you get a lot more juice at looking at the revenue side.
Yeah, and
right?
I was going to say the same thing. I think, it's typically revenue is where you can get a better bang for your buck.
Yes.
Spend more energy there, it works better, right? And the other thing to add, maybe around massaging, you can always massage your structure, right? That is in your control, right? You can make it a 90-10 split if that's what you really want to do because you need to get a better return profile for your investor. Those are the kind of things where you can start to get more creative on because the deal numbers are what they are, right? You're not going to be able to drastically change a submarket. You're not going to be able to drastically change a city rents, right? You kind of have a sense of what they are based on the comps.
Yeah.
Those things are hard to tweak. But you can always play with the structure, right? Adding in pref helps you do what? It helps you move cash flow to IRR. So if you're IRR deficient, you could put in pref, and now it pushes the IRR. You can do better splits. You can do a better pref, right? There are different things that you can massage, and we've played with these kind of different structures to see pros and cons, and that's the kind of stuff that you can do to help you hit the right.
Let me add one thing, though, right? If I see a 90-10 split, that's a big red flag.
I was going to skip. I don't want to get into that.
I'm not here to torch anybody's, but that feels like it's a really tight deal, and the GP is just trying to give enough juice to the LPs to make the deal work, right? Just realize what we do. It takes a lot of time, effort, and energy to find these deals and manage these deals. 80-20 is typically on the low end of what I would be looking at as an LP.
No, absolutely right.
Unless there's just something like it's a development play, there's something different or unique about it. But on a traditional multifamily syndication, C, B, or A asset, you should be looking at 80-20s, right? And you're gonna say, well, wait, if I'm an LP, why would I want to give up more? Again, it's because the only reason that they're actually giving up more is to make the deal work, right? So they're trying to give you more juice to get it past the 7 or 8% cash on cash threshold or whatever it might be, right? Otherwise, why are you doing it, right? So those are some of the red flags, right?
So Money Mondays are every Monday, 3:30 Central. If you have comments, questions, thoughts, please go ahead and ask them. We'll answer them live. We did get one from my wife, Noor, saying, what happened to the Starbucks today? Obviously, she tuned in late. She missed the beginning of the episode. He was supposed to go give me one. I roll in here, it's not here. I don't know, but hopefully I'm keeping the energy up, folks. Yeah. We'll have it on our next show. All right, so another question that came in before the show. What factors should you consider when evaluating an apartment complex for the first time? I think I go back to your buy box, right? Does the deal, is it the right vintage? Is it the right submarket? Is it the right size that you want to buy in, right? Those are some factors that you should be looking at prior to even getting into the financial analysis of the deal, right? And then you have to, if it hits those boxes, then you should have a return profile. Hey, me and my investors want to hit 7% cash on cash and 14 to 15% IRR. If the deal doesn't pencil into that, then boom, you move on, right? So those are some things that you have to consider right off the bat. And don't try to make the numbers work. There's just so many other deals and opportunities out there. It's just not worth it, folks. One more thing from another question from Amanda Larson. saying, what about the debt? Any red flags LP should look for?
That's absolutely great question, right?
Yeah.
There's right now it's choppy.
And I got so whatever debt they present, the one thing I will say is understand what your refi looks like, right? As an LP, the one thing I think a lot of people make a mistake on is say, hey, we're gonna refi at 70% LTV, right? We're conservative. But that doesn't really underwrite from a lender's perspective, right? Because it needs to be a 1.25 DSCR.
Yeah.
Of which I need to tell you about a product that I got told about yesterday on the airplane from the guy sitting next to me. Special Freddie product, but I'll tell you about that offline. But you can go down to 1.2 DSCR. But ultimately, the lender's not going to give you that big of a loan on the refi, so your return profile for investors is going to be reduced. That's a big red flag. And then I'd say just understand what's required to make that 3-year term a 3-1-1. Right, and what those triggers are.
Yeah, like loan terms, like that's important, right? Do you if you're still doing a bridge or a floating rate debt, which it can still be done to this day, right? Do they have an interest rate cap? We heard a horror story about, or at least I did. I meant to tell you about this over the weekend, and it was a deal here in Texas of some people that we know, and they're going to lose their shirt because they didn't buy an interest rate cap. And what's up?
No interest cap at all?
No interest rate cap. And so when you're going to say, what the heck's an interest rate cap? We've talked about it on the show, folks, right? It's essentially a hedge. If your interest rate goes up against it or goes above it, right, it's going to pay off the delta here, right? These folks didn't have any. So you can imagine they went into it thinking that, life was going to be great for the hold period and interest rates were always going to stay perpetually at 3.5%, and now they're at 7.5%. Well, you can imagine how much more in interest they're paying a month. And they're just getting annihilated. So they're having to sell the deal just to get out from underneath it, and they're losing about 50% of their equity in the deal, which is pretty bad. So you got to look and make sure that people are mitigating risk there too, right? So understanding the refinance and what needs to happen to get that refinance done. How long is the loan term? How long is the hold period, really? And then understanding, do they have an interest rate cap?
Yeah. So with that said, that's multifamily underwriting. Those are the kind of, the red flags and things to think about, right? So all of this impacts the deal, impacts your return profile, and helps you perform or not perform.
Yeah.
So let's keep going then.
All right, let's just keep rolling. So why is it important to consider factors that are behind the numbers? So I think this question is more about, what's the story behind the deal, right?
Yeah.
Maybe there's a reason why their income is lower, right? Maybe there's a reason why the expenses are higher.
Maybe there's a reason their taxes are lower, right? Or maybe they have a LURA in
That's
place,
actually
right?
I love this from the insurance perspective because obviously we own an insurance agency as well. And so we really know a lot about how insurance works. And I think there's this misconception that the past guy, was paying $75,000 for insurance, so therefore I'm going to underwrite it to $75,000. Well, what people aren't realizing is that not only are insurance rates going through the roof, because it is what it is, carriers are a for-profit business, this guy might be part of a master schedule.
Yeah.
Right.
Or they might be a large, they're BlackRock. They got 1,000 properties.
They might have 1,000 units, 10 trillion in freaking assets under management. Whatever. They're gonna get a better deal than you are. Right. So be careful with that. So you always need to validate your insurance.
Yeah. So understand the story. Key takeaway. Right. There could be a story to every deal.
That's a huge thing that people don't validate. Taxes too. They might be artificially low for one reason or another. Right. You need to understand that. They could also maybe just they're big and so they can keep their expenses low. Right? And so don't always just assume that whatever they're doing, that's what you're going to be able to step into.
Yeah.
Right? So understanding that story is huge.
Yeah. And last but not least, contingency, right? What's the goal with contingency? As we've learned the hard way, right? Contingency and reserves can make or break a deal, right? Especially once there's choppiness. And so, having ample reserves is really, really important, right? And people always ask, what is ample reserves, right? And I'd say, honestly, I've probably gotten to the point where I feel like 8 months of your note and payment in full is including escrows, is ample reserves at least.
I'd say 12.
Right. It used to be 2 months. I think is what people used to say, and I say it's at least 4x that. And we sleep much better at night knowing the reserves that we have, right?
Yeah. So. And don't get me wrong, folks. Everybody made these mistakes when they got in, right? They either you can barely raise the money and you're just kind of squeak by, but if you can raise that additional capital, you and your LPs will sleep a lot better at night. And then, 5 years down the road, you maybe go to refinance and you don't need any of the money, you can always give it back to them too. I think your LPs would appreciate that, right?
Yes.
Last question, right? For multifamily properties, why is location a major part of assessing the attractiveness of a deal? And I just say, some parts of the country are going to be growing better than others.
Short
right?
answer is it makes your life a lot easier. Let's keep
Yeah,
going.
just you'd always like to have a little bit of wind at your sails, right? Yeah. So that's important. So always look at the submarket. Stick to that box, right? We've talked about your buy box before. So boom,
that's
we got through it.
Money Mondays is every Monday, 3:30 Central. I know there's some questions that had come through, but if you have questions, ask them. Otherwise, I know we're already over time, so let's keep going.
All right. Okay. All right. So join us at the next MFIN Conference.
It's going to be the big one, folks. 800 people. It will sell out, so please book your ticket sooner than later. Yep. It gets more expensive each week on the week until it becomes $1 million per ticket. So make sure to book your ticket sooner than later. MFInvestorNetwork.com and use coupon code DISRUPT to get a nice discount on it.
Or let's give
right now it's the pre-register.
It's MFInvestorNetwork.com/Houston 2023.
I think it'll automatically go there now.
All right.
So
and you get your $200 off with the pre-register sale.
Yeah. So
and
definitely
again,
book it. It should be a fun
up.
time. Come hang out with us and 798 of our friends.
Man, 98, that's pretty specific, but we're going to go with it.
Us plus that is 800. That's
true. That's true. So Houston Real Estate Investing Holiday Networking Mixer. Oh my gosh, I can barely get that off my tongue, but it's going to be a great time.
Come check it out.
Funky sweaters?
Yeah, funky sweaters. I don't even
Crazy
own
giveaways?
one, so I'm going to have to get one of Ben's shirts. But, Ugly Sweater Contest, come hang out with us. We're not going to present anything. We do a lot of presentations. It's our
Might do a raffle.
Here in
that
Houston,
out there,
we do this the first Thursday of every single month, so we'd love to see you guys there. Come, see us, be there, be square.
Ooh.
Hopefully we don't get...
When is that? December 1st,
December
2022. So that's coming up in a few weeks after, obviously, Thanksgiving, folks. But 7 p.m. Central Standard. If you're here in Houston, Wakefield Crowbar. It's out near the Heights, right? DisruptEquity.com/HTX meetup. We love doing these. Typically get 100, 150 people out there. It's always a lot of fun. But what are we talking about next week, my friend?
Do's and don'ts of partnership and multifamily. Learn from the mistakes I made in choosing a partner.
I knew it was coming.
And there's good partnerships and bad, and thankfully we have a good partnership, and we've seen people that have struggled, right? And so kind of talk through those, and how things work and what to look for when trying to choose a good partner to grow.
Yeah, so check that out. Excited about it. See you next week. We do this every Monday at 3:30
Central. Thank you.